everybody. It's Tom Sheridan and Chris Darbyshire here to report on what is in store for Q3 2015. And my goodness, haven't we had a year so far? We've had more than a full year in less than half a year, Chris. We had a blistering Q1. Terrific performance. Markets were really, really buoyant. And all of a sudden in Q2, the world began to have doubts. The data in the U.S. was very, very dodgy for quarter one. GDP was a big disappointment. Question was it for real or was it just the data again? China, definitely slowing down in China. Europe, well, we had all sorts of things going on in Europe, and not to mention deflationary fears. Emerging markets, are we having another taper tantrum? Is this going to be the mega taper tantrum? Japan, really needing more stimulus. The impact of the VAT rise had an impact, and they're still trying to climb back from that possible setback. And of course, in the UK, we were looking forward to elections. And surely we were going to have a coalition government that was going to lead us to who knows what. And of course, that's not the way it all worked out. So for the first time in 3 years, 7IM found itself no longer overweight in equities. For the first time in a couple of years, the bond markets that we've been waiting to see react finally saw rising rates. And last but not least, we're seeing a lot of fat tail risk visible on the horizon. Which one of those potentially big events is actually going to hit? And more importantly, how do we position portfolios against it? Set the scene at the beginning of Q2, walk us through what we did during the quarter, and then we'll catch up on where we are now.
So going into Q2, we'd had, as you say, an extraordinary Q1 when the European stock market had outperformed the US stock market by about 20% in a very short space of time. And we'd been positioned exactly for this to happen with lots of European equity and virtually no US. At the same time, the dollar had been very strong and the euro had been very weak, and we'd got our hedging right at the same time. So we had this good performance going into Q2. And as you say, we saw the doubts quite early on in Q2. The US data began to weaken. It was dismissed as being weather related, but we weren't sure that it might not be US dollar related. And that might be a slightly more difficult thing for the US economy to get over.
Is the strength of the dollar hurting earnings in the US?
Exactly. Hurting earnings in the US and hurting exporters and hurting the competitiveness of domestic companies that are competing with importers in the US market as well.
And we've had about a 20% appreciation of the dollar over the last year, haven't we?
It's been phenomenal. It's been the biggest rise in the dollar in well over a decade. So all of those factors began to make us think, well, maybe we should be a little bit more careful. We love what's going on in Europe. European earnings look good. European economy is doing very well. But if the US is genuinely slowing and has a problem, then you could see actually that having an impact on markets generally.
One of the big headlines that we've seen in the press over the last couple of months is China. China has been gradually slowing. We went a year ago from 10%. Oh, maybe it's going to be 8%. No, it's going to be 7%. Actually, it's going to be 6%. What's actually going on in China? It's a major, major part of world growth and very, very important to our portfolios.
Continues to slow economically, China. But I think the silver lining there is that the slowdown isn't accompanied with social stress or with economic volatility. In other words, it's a managed slowdown of the economy there.
So the government is intentionally slowing down the economy?
As it has to do. As your economy gets bigger, it cannot grow at the same rates that it used to grow.
And the debt problems that we saw in the U.S., are we in danger of replaying some of those in China?
Yes, I think there's definitely debt problems in China. However, I think some of them are due to the way that society functions, which has not been a very equity-orientated society. It's been a very debt-financed society. So economic growth there has been financed with debt. So I think we can make some allowance for that.
So are we looking in China at something we're very, very worried about, or are we actually encouraged by the fact that the Chinese government has recognized that there are issues on the horizon and they are dealing with them?
On the whole, we're encouraged. We think that as economies go from being very fast growth to slightly slower growth, albeit still positive, actually the stock markets do very well. And we've seen exactly that in China. Over the last year, it's been the best performing stock market by far around the world.
That's another story. We'll get to that later. 100% rise in Chinese shares this year already. That's a wild one. The rest of Asia, Chris.
Yeah, we still like Asia. So within our emerging markets positions, which are still quite large, we have tried to focus on Asia, particularly Japan, where we still have our significant overweight. And Japan has sort of come up on the rails this year and has been the best performing stock market aside from China.
Indeed it has. So our first quarter, very overweight Asia, overweight emerging markets, increased positioning in Japan and Europe. We looked terrific. Then the second quarter came, and what happened going into the second quarter and during the second quarter? And more importantly, how did you react to it in regard to portfolio positioning?
So we anticipated that the US slowdown might become more of a problem. And what we did was we took off the positions that we were holding in Q1 that had been so successful. Now let me be precise about that. We left the equity positions in place, so the big European overweight, the big Japanese overweight, and the US underweight. But we then reversed our currency positions. So we went from being completely hedged on the euro to completely unhedged, and from being completely unhedged on the dollar to completely hedged. In other words, if those trends had reversed, we were worried we would give back quite a bit of that performance from Q1 potentially. Right. So by making those changes to the currencies, we sort of neutralized the chance of that happening.
And how did that work out?
Well, it took a lot of risk out of the portfolios. It basically meant we were level pegging for a while. We'd reduced the portfolio's ability to really surge on good days, but also we'd reduced the ability of the portfolios to really fall on bad days. So we ended up being sort of treading water for a couple of months.
And after a very good Q1, a little bit of risk off the table, not a terrible idea, and in fact was encouraged by a lot of the people who use us for their investment portfolios. Now, Europe hurt a little bit during the quarter, particularly the equity markets where we had an overweight position, and you did take some action early on in the quarter. Can you explain what you did there?
Yes, so the currency moves was very early in the quarter, and then about halfway through the quarter we took 5% out of our European overweight and put that into cash. So we went from about 14% in our balanced portfolios in European equities back down to 9%. Still overweight, but a much smaller overweight.
So in a balanced portfolio during the middle of Q2, we found ourselves with about 15-16% cash for a good part of the time. And that was a very conscious decision, and in retrospect, we're quite happy that we did it. Now, looking forward to Q3, we've had our little wobble in the world. Is it going to be continuing slower growth? Is the issue with the Fed and their dot plot versus what the market really thinks is going to happen going to play out in favor of the Fed, or is it going to play out in favor of the market?
So one of the awkward things during the second quarter was that the Fed seemed to be very hawkish, so very in favor of raising rates, just as the US economy seemed to be slowing. And then at the end of the quarter, the US economy actually seemed to get back into a higher gear. And the Fed at the same time then became very dovish. So deciding whether you invest in line with the economy or in line with the Fed has really been a critical decision. It's been very hard to get those decisions right. What we're doing now is we're going to go to a position where we're half hedged on the dollar. So at the moment we're fully hedged on the dollar. It's been a great position for us. We hedged at 148.5 and now it's up around 159. We're going to go back to being half hedged. So we think the dollar might have another bit of a surge.
Now, we have had almost nothing in U.S. equities. Are you going to stay with that position, or are you going to move that?
No, we're going to go back into U.S. equities, and this is one of the ways that we're going to put dollar exposure back into the portfolios. And the thinking there is that the U.S. equity market has been actually very stable. Despite our worries over the US economic picture, the stock market was incredibly stable there. And it's becoming a bit of a safe haven to be in the US stock market if you're worried about global growth.
So where are you taking that money from?
And that money is coming from China. So we've
the
actually already
100% up market.
That's right. So we've already actually done this trade. So we took our money out of China A shares, that's the domestic onshore shares, and put it into US shares.
Good. You definitely got my vote on that one. So we moved a little bit of money out of China into the US in the equity market. The European equities position, you had taken 5% of it out during the quarter. What are we looking at going forward with the European equities?
We like Europe. Economy is doing very well there. It's had a very good run of data. And the earnings there are actually also looking very good. So you've got that combination of good economy, good profits. I think it's the place to be. Greece has made us want us to leave it a little while longer before we go back, but we're minded to put some of that 5% back in.
Okay. And Japan's been a very important position for us, as you said before. Are we staying there?
Yes, we're going to stay in Japan at about the same level, which is about 9% of a balanced portfolio in Japanese equities. The story in Japan continues to change in good ways. So not only now do we have Japanese companies that are beginning to buy back shares, return cash to shareholders, which they've never done in the history of the world, but also the economy there is beginning to show a little bit of growth that perhaps we didn't expect. So maybe Abenomics really works after all.
So, Chris, you're painting a more benign picture of the world than some of our competitors will paint. You're telling me that the U.S., the first quarter was probably a bit of an anomaly, looking okay. European growth, not looking too bad. Japanese growth, looking okay. China, a slowdown, but an orchestrated slowdown. So this is not the kind of portfolio that wants to go ultra defensive at this moment in time. And we realize that there are some in the market that hold that view. Having said that, we've gone from an overweight position down to a neutral position. And is that about where we wind up on equities?
So that is really where we are. So it was really during the quarter that we went from being pretty risk on back to neutral. And now I think we're reevaluating how we position that portfolio and whether we should maybe move a little bit more back into risk as these fears that we had really from several months ago begin to become prevalent in the market.
Okay, so the currency positions going forward. You've already told us that we're going to be half hedged on the dollar. You told us that we continue to have exposure to the euro. We continue to have exposure to the yen. Is that about where we are in currencies?
One thing we did do was about a week ago, we fully hedged our exposure to the euro as well. And that was purely Greece related.
Okay.
And that's played out very well.
And that's going to stay there?
For the time being, yes.
Moving on to bonds. So bonds all year long, actually for the last couple of years, we've been very short of duration. We waited last year for interest rates to rise in the bond market. It didn't materialize. It has started to happen in 2015, and our short durations have looked much better. We've had currency and credit exposure in the fixed income part of the portfolio. What are you going to do going forward in the fixed income component of the portfolios?
So the one big change there is that we're going to put a significant amount of money into US inflation-linked government bonds. So these are called TIPS in the US, called Linkers in the UK, TIPS in the US. And we're going to put about another 4% into them. We've got about 2% in Italian index-linked government bonds at the moment. And the reason for that is it's partly we like the US dollar exposure. It's a way of getting US dollar exposure. Secondly, we quite like the valuation of US index-linked, which is far, far better than UK index-linked, for example. And it does give you that inflation protection. And inflation expectations have really come down an awful lot, even over the last 18 months, 2 years, which makes those expectations look maybe a little bit too low.
So expectations, define that for us, are down around, what, 1%?
Yes, just over 1%. And not long ago, we're at 2%, actually.
And so you're really looking for 2.5% inflation expectation. You're not looking for 4 or 5, 6.
No, we don't think there's a huge amount of upside here. But what this gives us is it's an anchor in the portfolios. We haven't used bonds to anchor the portfolios for a couple of years, as you say. We've tended to try and use safe haven currencies instead. Now we have a genuine bond anchor in the portfolios that we think has some, is relatively attractive.
So the Asset Allocation Committee expressed their fear that there were big tail risks out there in the world. And two of the ways that we can mitigate those risks are with the dollar and with the tips, and you get both of those in the same position there.
Exactly.
Well done, Chris. Now, in summarizing our overall positioning going forward, is there anything that you'd like to add to the equities, the fixed income, and the currencies?
I think we're cautiously optimistic. I think during the quarter we went through a period where we were just plain cautious. Now I think we're cautiously optimistic.
Well done you, managing through a turbulent quarter two of 2015, and hopefully with somewhat calmer waters ahead in Q3. And that's the way we're positioning 7IM portfolios. Thank you very much, Chris.
Thank you.
Thank you.